The whole internet is filled with edgy headlines of the market carnage we witnessed on 13th March this Wednesday. To give you a statistical context, the continued sell-off in the mid and small caps eroded billion-dollar market value in less than 2 days. On 13th March, about 1,050 small cap stocks hit a lower circuit. In the broader markets, 60% of all NSE stocks have declined between 20 to 40% from their 52-week highs. If we exclude top 1,000 NSE companies by market cap, then out of the balance, 88% companies' share price went down between 20 to 40% from their 52-week high levels. Overall, the Nifty Midcap and Small Cap 100 Index is down 6% and 13% respectively from their all-time highs. Now, 6 potential reasons behind this market correction are: excessive valuation in a few pockets. There is too much money flowing, particularly in some small and mid-cap stocks. Recent remarks by RBI and SEBI on irrational exuberance in the small and mid-cap space made the market cautious, especially after SEBI chairperson Madhavi Puri Buch's comment on froth building in certain market segments. She said that the valuations of some stocks in the mid and small cap segment seem to have gone off the charts. SEBI's letter to AMFI to frame a policy to protect the interests of investors investing in small and mid-cap mutual fund schemes has led to the suspension of fresh inflows into the small and mid-cap mutual funds by the top AMCs like ICICI Prudential Mutual Fund, Kotak Mutual Fund, Nippon India Mutual Fund, SBI Mutual Fund and others. Separately, AMFI has asked its members to conduct a stress test of mid and small cap schemes and disclose the results by 15th of every month to help investors get a sense of how liquid their mutual fund assets are. This made the market cautious about the mid and small cap indices. Consumer Price Index, that is CPI, and industrial growth numbers came in flat month on month as compared to the slightly higher expectations. Release of the electoral bond data by the Election Commission just before the general elections has sparked debate across the country. Amidst all this, one thing to remember is that the equity market is not a one-way street. Like Mr. Vijay Kedia says, euphoria in the market will not last forever. In the long term, India's structural growth story is intact and there could be market corrections like this one to test investors' conviction. So don't panic and keep holding on to the good stocks in your portfolio. Buy quality names that have reasonable valuations. Uday Kotak, a prominent figure from the banking industry, said that the market has not yet escalated into a full-fledged bubble and that the situation is not entirely beyond control. Mirroring a similar view, Prashant Khemka of White Oak Capital assured that there was overconfidence setting among small caps, but what we saw was a healthy correction. If we look at the historical charts of the Nifty Midcap 100 and Nifty Small Cap 100 Index, both indices have seen periodical corrections over the last 5 years. However, the 5-year CAGR data shows that Nifty Midcap 100 Index gave 21% CAGR returns and Nifty Small Cap 100 Index delivered 17% CAGR returns versus Nifty 50's 14% CAGR, which paints a larger picture that these market corrections are an opportunity in the long term.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.